Let's go right now to Edward McKelvey. He is senior U.S. economist at Goldman Sachs. Ed McKelvey, good noon to you.
Hi, how are you?
Oh, I'm good, Ed. I can't keep up between your great housing note and QE2, and you got to talk the budget with Ed McKelvey. Let's talk QE2 first. $600 billion, better than $500 billion, $75 billion, less than a presumed $100 billion. They were trying to please everybody, weren't they?
Well, it looks that way. I mean, it sounds like they probably had a little bit of internal differences of opinion, perhaps, on exactly how to structure this, and perhaps some discomfort on the part of some people about $100 billion a month. And so they found a compromise, and I think it's reasonably close to what the market was looking for. Not exactly, of course, but reasonably close.
Dr. McKelvey, we're bringing up here the Goldman Sachs forecast. You and your colleague Jan Hatzius, a likely $2 trillion overlaid on. That's that red circle, folks, up top there. I put it out a couple years. And then the $600 billion is the orange circle. Ed McKelvey, do you and your team reaffirm that we may possibly see $2 trillion of quantitative easing?
Yeah, that's our best estimate at the moment. It's obviously conditioned on our view of the world, and so it will be subject to review as the data come in and tell us either that the economy is better or worse than we might expect.
Some people see recent data that has been better. What will we see with tomorrow's jobs report? Will it give us the information that will reaffirm what I'm going to call, Ed, I don't mean to editorialize, but your grim 2011 forecast of a persistent 10% unemployment?
No single report will necessarily do that. We are looking for another report that shows modest gains in private sector, about 75,000, and in the public sector, I think we're losing jobs. So overall, payrolls are only 25,000 in our estimation. So that'll be a disappointment, I think, compared to some expectations, and the unemployment rate probably just hangs there at 9.6 or so.
Ed, I want to link in here the work of Chairman Bernanke. We saw it in the Washington Post today, folks. Here it is, the Washington Post, as Ben Bernanke says, what the Fed did and why we have made all necessary preparations, and we are confident that we have the tools to wind these policies. Ed McKelvey, do you share the confidence that Ben Bernanke and Bill Dudley, Brian Sack, the Fed team, smartest people on the planet, supposedly, that they have the ability to unwind quantitative easing when we need a more restrictive policy?
I do, and particularly because I think the markets tend to assume that when this exit needs to be done, that it will need to be done in some very rapid fashion. I think that's a mistake. Once you get to the point where the economy is growing at an above-trend rate, you're bringing the unemployment rate down noticeably. At some point, they will start to want to tighten credit. They're going to have a lot of time before they really run into any kind of serious problem with inflation or anything like that.
Okay, this is what I'd like to do, folks. You've got Dr. McKelvey there with a statement of optimism, as we heard, for example, from Ethan Harris at Bank of America Merrill Lynch. Play this cut, folks, from this morning, Bloomberg Surveillance. Conrad DeQuadros of RDQ Economics. He disagrees with the present Fed policy.
Well, we don't think that we should be doing QE2. I think that the Fed is not so much looking at the growth rate of the economy. They're looking at the growth rate economy relative to potential growth and the fact that we have a significant output gap. And so the Fed is willing to continue to provide very accommodative policy, even on moderate growth, because the output gap is so deep. So, yeah, I think it's just a different focus. Our focus is quite different to that of the Fed.
The nuance there from Conrad DeQuadros. Ed McKelvey, as you say, it's his confidence of the dynamics when they have to become more restrictive. The confidence of, can they raise a target rate at the right time? Can they pull back in that $600 billion, or even more so if we get the call you've got here? Push against what Conrad said there. You have the confidence that they will have time to react.
I think the issue here is, what is it that drives inflation? Our view, and I think the Fed's view, is that the predominant factor that affects inflation is the amount of excess capacity in the economy. As long as the economy is growing at a below potential rate, that excess capacity is already large and increasing. So the pressure on inflation in the near term is down. And once you get to the point where the economy is growing above trend, then the capacity starts to shrink, but it shrinks from a very high level. And so I think the Fed does, in fact, want to raise the growth rate above the potential. Whether it can do so is a different question. Once that growth rate does get above potential, they have a fair amount of time, because it will take time for that excess capacity to shrink to the point where inflation is truly a threat.
Which market data do you look at to try to measure that capacity? Is it as simple as capacity utilization? Do you look at jobs, or do you look at the troubled housing market?
I think if you're looking at one overall measure, the best one is the unemployment rate against whatever you think the structural unemployment rate is. And there's no question we don't know some of these things to any kind of degree of precision. But when you're looking at 9.5% unemployment, I think it's a stretch to say that that the structural rate is anything higher than, say, 6. Our best estimate is about 5.5. And in that kind of situation, you've got enormous amount of excess capacity.
Like under 9%. When are we going to see under 9%? You and I are going to be older, Ed. When are we going to see under 9% unemployment?
Well, I imagine we'll be older by tomorrow, actually. But the unemployment rate goes below 9%. In our forecast, we don't have it going below 9% because we only have a detailed forecast out to the end of 2011. If you kind of think about what the economy might do beyond that, it could be another year after that.
Remarkable. Ed McKelvey of Goldman Sachs with us, folks.